Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Bernoulli with Peter Boockvar. Peter is the Chief Market Analyst with the Lindsay Group and the Co-Chief Investment Officer with Bookmark Advisors. Welcome, Peter.
Good to be here. Thanks.
So a lot happening now with the U.S. election over. There's generally a lot more excitement by Americans in the elections than up here in Canada. And a lot will have an effect on the financial markets, on infrastructure spending, Federal Reserve policy, government regulations. A lot of these factors stem into our view of financial repression and the effects on the financial markets. So if we can begin with a discussion on what your feedback is from the elections, how you see that playing out, and what the effect is of the infrastructure spending on inflation, how that will affect also debt levels and the challenges in servicing that debt.
There's a lot there. Let me start by saying that the reversal in markets from what was going on last night to the rally today is hopes that Trump, through easing of the regulatory burden and cutting taxes, will give the U.S. economy a kick in the pants. Now, what kind of infrastructure is a part of that? In terms of fiscal policy, we'll have to see. I'm sure they'll spend money, build new roads, and so forth. But on the other hand, what's his trade policy going to be like, and what kind of drag is that going to create? Either way, inflation pressures have been building anyway. Going into the election, the Roy Industrial CRB index was up 11 out of 12 days at a multi-month high. We saw a backup in interest rates that had really started in August when the Bank of Japan, and the European Central Bank started to back away from flattening yield curve. So it's sort of a perfect storm going into a Trump victory and the rise in inflation expectations that are also evident today. And therefore, we're seeing this sharp rise in long-term interest rates. So it's an interesting day where interest rates are spiking at the same time that stocks are rallying.
Do you see that as a trend in terms of the bond market? Even at the long end, it's taken a big dip today, rising interest rates, rising yields. Is this the beginning of a medium or a long-term trend?
Back in middle of September, I called the end of the bond bull market of 35 years, and I'm sticking with that. So we saw a bottom in the 10-year yield at 1.53% right after Brexit, and we are now basically 50 plus points higher in that yield. And it's not because the U.S. economy has gotten much better. It's a mixture of the things that I mentioned previously. I do expect interest rates to continue to rise in the long end. I think the Fed's going to be playing catch up when they eventually raise rates in the short end. And I think it'll be a challenge for stocks to continue to rally in the face of the rise in rates, since a large part of the bull market in stocks is predicated on artificially low interest rates.
Is there a trend that could be said that the fall in the bond market representing outflows from the bond market would then be taken back into inflows into the stock market? Is that a potential trend?
Well, there's really no such thing, because for every dollar that comes out of the bond market, a dollar has to go into the bond market. For every dollar that goes into the stock market, there needs to be a seller and a dollar coming out. So the idea of money coming out of one group and going into another, well, there has to be the reverse. And so that's not necessarily a factor. I think this is a lot of people were long puts going into the election, hedging against a potential Trump victory. And so we're seeing massive put selling, which lends upward pressure to the market. Obviously, the groups that should be rallying and that's particularly healthcare, financials, and defense, since they've been, at least financials and healthcare had the regulatory noose around their neck over the past couple of years, getting some relief today, which is encouraging. But we're also seeing some high-valued, overvalued stocks that are being challenged today by the rise in interest rates. Net, we'll have to see what Trump is going to be able to to get through. I'm optimistic that the economy could improve based on its policies, but at the same time, the headwind will be the rise in rates and what potential crimp that's going to be.
If that's the case, would that put any damper on the desire and the goal to increase infrastructure spending through government stimulus, government fiscal policy stimulus?
Yeah, I mean, we'll get that, but we got that in, 2008. We had almost $1 trillion quote-unquote stimulus package and shovel-ready projects. Now, the government just going out and throwing money out there and spending it is not always the most efficient use of money. There are plenty of estimates out there saying that the multiplier effect is below zero. So to think that rebuilding roads and bridges is somehow a panacea, I think, is hugely misplaced.
And not to mention that usually government is not in a good position to make the right assessment and decisions on which infrastructure projects would make sense, which infrastructure projects would be successful.
Correct. There's infrastructure projects going on every single day in the United States. To then layer on another bunch of infrastructure spending, I'm not sure if that money is going to be very efficiently spent. Anybody who's in the tri-state area in the U.S. can drive around and see that there's always some form of infrastructure spending going on.
Mm-hmm. And with an increased level of infrastructure spending contribute to the trend of rising inflation?
Well, potentially, if the demand for goods and labor and raw material exceeds the supply, it certainly can. Also, if you continue to add up deficit spending and debts in this country, that potentially is going to be, potentially inflationary as well.
And in terms of Federal Reserve policy, do you see the new administration having a different view on that? Will there still be maintenance of Federal Reserve independence, or will there be a greater linkage between fiscal policy and monetary policy?
I would think it would be extraordinarily dangerous if there was any linkage whatsoever. I think Trump is going to take a step back and get out of the business of criticizing the Fed, even though I think it's healthy that the Fed does get criticism. I think Janet Yellen's term is up in January 2018, and she will retire into the sunset to be replaced by somebody else. There's no question about that. And I think she just wants to get out alive, so to speak, over the next 12 months.
And for your forecasts on the different asset classes, can you give us some insight how you see the financial markets playing out in the stock market, the bond market, the currency market, and the commodities market over the short, medium, and long term?
I'm of the belief that the action in the bond market is really driving the bus and will continue to. It's been the main driver of this of this equity bull market, with the suppression of interest rates to near zero and multiple rounds of quantitative easing. So we built this economic construct based on an artificial level of interest rates that, if rates go up, I think that potentially threatens economic activity, but also market multiples.
And do you see any correction short term in the stock market?
I think if interest rates continue to rise, yes. I'm surprised we weren't getting it today.
Given this, how can investors protect themselves and be successful in this challenging investment environment? What asset classes make sense within what time frame?
Well, I think the reflation trade, I think, is going to continue. Commodity prices have been in a 5-year bear market. Gold and silver, in particular, has been through a 5-year bear market. And I think we're going to see a rise in inflation and a fall in real rates, because we can be sure that the Federal Reserve is going to be well behind schedule, so to speak, in raising short-term interest rates. And I think cash is a good asset right now. And I think emerging markets is an attractive place even after the run they've had.
And would be the effect on Federal Reserve policy by the new administration, and would the policy of plans that the Federal Reserve has now in terms of normalizing or at least raising interest rates to some extent, would that be affected?
Well, they'll raise in December, and unfortunately, they're going to be forced to raise next year if inflation continues to creep higher. And that's the last position the Fed wants to be, is being forced to raise interest rates rather than doing it on their own volition.
And on a global scale, how do you see the potential for rising protectionism and restrictions on trade, which President-elect Trump has mentioned? How do you see that playing out on an international scale?
That's the potential danger of his presidency. If he carries out a lot of the things that he talked about, that would be a huge negative, because tariffs and protectionism is essentially a tax. That in itself is also inflationary as well. So it would be a toxic mix if he actually implemented the things that he has threatened. The hope is that he's going to surround himself by more rational economic minds, and that a lot of what he said is just mere talk rather than something he'll implement.
And the idea of doing infrastructure spending, again, would that be negative on the bond market at some point, or in terms of the level of national debt, how much that would?
Well, we're already seeing evidence of that today. I mean, this is just potentially a dress rehearsal. I mean, a 10-year yield move of 20 basis points is extraordinary.
So it could be an effect where the potential for infrastructure spending, the level, could be limited by what the financial markets are reacting to.
Potentially, but I think they're going to try to get away with what they can. But again, it's a matter of whether it will actually translate into economic growth. The market multiplier in government spending, in many cases, is barely above zero, and some will argue below.
And what about on effect on government regulations like financial reform? Do you see any new developments on that, given the new administration coming in?
Well, I guess there's hope that Dodd-Frank, the Boockvar rule, for example, and just the whole regulatory noose that's been put around banks is going to ease up. That's the hope. It'll be a work in progress, but regulations across the entire country hopefully will ease up on business and individuals.
And those regulations, would they be affecting economic activity, or would it be more on like financial bank issues like bank bail-ins, bank bailouts?
Well, I think it's going to be across the board, but certainly the areas of where the regulatory constraint has been most pronounced is certainly in the financial sector, and it's the one area that can use some relief.
Today's rally, how can you explain that, given that there was an expectation for the markets to drop? There was a significant sell-off in the futures last night to limit numbers -5%. Any ideas how it came back or why?
Well, there's the hope. Well, it's being driven by those areas that have been beaten down on fears of a Hillary presidency. So that's helping to bring back the market. But there's also hope that Trump can bring a pro-growth agenda to the White House.
Okay. Any final thoughts on your feedback of the output of what has happened on the elections?
I think people have to keep their eye on interest rates. I think that's going to be the main driver of asset prices generally, particularly stocks in 2017. And while the interest rates need to normalize, they need to go higher. I don't think that the central bank experiment over the past 7 years is as a free lunch, and that there's going to be a painful transition to more normalized interest rates, again, which is needed over in the big picture.
And could the end game in that sense be in an attempt to keep interest rates low, that perhaps the currency or the purchasing power of currency is sacrificed?
Well, yeah. I mean, I think that the debasement of currencies will continue. There's no question. I mean, that's not necessarily going to all of a sudden change, and actually could get worse if we continue to build up all these debts and deficits.
Mm-hmm. Great. Thanks very much. How can our listeners learn more about your work, Peter?
Well, my research work, it's thelindsay.group.com, and the asset management business is bookmarkadvisors.com, and we are a member of the Advisory Services Network Group.
Great. Thank you very much, Peter. Great talking to you.
Thank you.
We also have Alasdair Macleod online, and he is head of research for Gold Money. He's also an Austrian School of Economics economist, and he has a background as a stockholder, banker, and fund manager. Welcome, Alasdair.
It's nice to be with you again.
Great. And so what are your thoughts on yesterday's election, the outcome? Where do we go from here?
Well, I found the whole thing fascinating because having been through Brexit, I was getting deja vu all over again, as Yogi Berra would say. Yeah. It was fascinating. And I was also fascinated at how all the media misread this completely. I mean, we have the dear old BBC here, and there's no doubt they were sort of fed the media line. They didn't understand what was going on, and it was a huge surprise to them. It wasn't a huge surprise to me. I thought it was quite possible that Trump would win it. I wasn't certain he would win it, but I felt that what had happened to Hillary Clinton over the email scandal, I think was one reason why she should have lost, because we all know politicians are dishonest, but we don't like it having it flaunted in our face. And the second thing, I just noticed that every time she seemed to be appearing on a platform, she was surrounded by women, basically pushing a women's liberation view. And I think if I was a sort of a moderate, reasonable American guy, perhaps middle-aged, I think I'd get a bit tired of it. And I don't think that was good tactics. I really don't.
Yeah, and I guess you also, I believe, predicted last week that it would be a victory based on the electoral votes versus the popular vote. Yeah,
I did.
And that seems to have carried out, yeah.
Yeah, it got there by a slightly different route from what I thought. So I can't say that I had really great prescience. It just sort of worked out right.
Yeah. Now, how does this all affect the financial markets and economic fiscal stimulus? So he mentioned this morning, President-elect Trump, that there would be significant increase in infrastructure spending and sort of like a Keynesian stimulus, if you will. Do you see that as being beneficial or, taken from an Austrian School of Economics approach, would there be challenges by the government in picking the right infrastructure projects? Which ones make sense? Which ones will be successful?
There always is that problem. But I think the problem is actually slightly greater than that, insofar as it's all very well having an infrastructure project. I mean, most infrastructure projects, unless you're building bridges to nowhere, do have some rationale, and the market adapts to use them. I mean, I was thinking when Trump was saying that, I was thinking about the Hoover Dam, for example, which was an earlier version of the same thing, because that was President Hoover, I think, before he retired back in 1930, 1931. It was after the Wall Street crash, anyway. So it was a similar sort of situation. He was trying to stimulate the economy. I think that Trump's real problem with this is that everyone is underestimating how rapidly government finances are deteriorating. And the reason I believe that they're going to deteriorate very rapidly from here is because of something that Peter was talking about, and that is a pickup of inflation in 2017, in the next fiscal year. And that inflation basically means that government's income gets squeezed, because on the one hand, they find that rising prices, and if they're doing infrastructure development, you're looking at the raw materials, if you like, an index of non-food raw materials. Those prices will rise in dollar terms, making it more expensive than originally thought. At the same time, you'll find that the lags, if you like, in terms of tax collection, other than sales taxes, means that government's income doesn't keep up with the pace of inflation. And already, I think that the underlying budget deficit is actually large and going to get larger. So it's difficult to see how Trump will be able to finance substantial infrastructure projects, particularly if at the same time he intends to cut taxes. He's starting from the wrong base, if you like. That, I think, is the fundamental problem.
So it may be too late from this period of very low, quiet, even zero interest rates, negative interest rates. It may be too late, perhaps, for being able to borrow significant amounts of funding to do these infrastructure projects.
Well, we can't necessarily say too late, but what I would say is too dangerous rather than too late. I mean, you could, in theory, you could run up a budget deficit in the same way as the Japanese have, so that you end up with government borrowing being 250 times GDP. I mean, if America was going to go down that route, in theory, you could argue that it could borrow another 20 trillion quite easily, but I think that would be regarded as completely irresponsible and unlikely even to be attempted by the most wildest Keynesian. It just doesn't make any sense.
And that would be the case even if they also did a simultaneous fiscal stimulus and monetary stimulus at the same time, whereby using monetary stimulus in an attempt to keep interest rates low through quantitative easing.
Well, yeah, but you see, the problem is that if inflation starts picking up, and I think this is a very, very important point, because raw materials have turned the corner. And I don't know if you've noticed, but the price of copper has hit new highs for the year. It's been rising for the last 12 days in a row. And that's telling me, Mr. Copper is telling me that base metals are going up and up and up. And the effect of this, these raw material price increases, is going to feed through to wholesale prices and obviously into retail prices. So the Fed is going to find itself, I think, quite rapidly in a situation next year where inflation at the CPI level is knocking on 4%. And they are worried about raising interest rates because of the level of indebtedness in the economy. And if they raised interest rates to more than 2.5%, there is actually a severe risk that the whole economy falls over because of all that outstanding debt. So you've got a bit of a crunch developing already. The last thing you want is to exacerbate that by running out and borrowing huge, great quantities of money to finance tax cuts and to finance infrastructure spending. So I think it's actually a very difficult situation as far as Trump is concerned. He's going to have to pull back quite severely on his intentions in that direction.
And how does this all play out in the financial markets? So if that is the case, would that mean that infrastructure stocks as an asset class, for example, may not benefit as much as people are currently thinking?
I think that's right. I mean, Peter was making the point earlier that the bond market has peaked, and I would concur with that. And I would go further and say not only has it peaked, but I see prices in the bond market falling quite considerably, and so much so that the falls in US Treasury prices are likely to transmit into falls in sovereign debt prices around Europe, which in turn will threaten the banking system in Europe because all the banks are loaded up with Italian debt, Spanish debt, French debt, etc. So I don't think 2017 is going to be an easy year. And I'm not saying that it's a year we can't get through without major instability. But I think that the idea that there is leeway for governments to spend their way out of problems, I think, is wildly optimistic.
And so therefore, the effect on the stock market as a whole, how do you see that playing out in the medium term?
Well, again, if you get rising bond yields, then you get falling stock prices, and I think it's as simple as that. I can see equity markets falling very significantly on the back of rising bond yields, but at some stage, I suspect the difference between this decade and the 1970s. Bearing in mind that in London, in between May '72 and January 1975, the London equity market fell over 70%. There was a huge rate fall. I'm not sure that we will get a 70% fall, because I think the end game in this is that the companies that can survive accelerating inflation, which the Fed is powerless really to deal with, I think that the end game is somewhat different. And at that stage, equities are going to become not so much a liability, but more a means of protecting yourself against inflation. And that was certainly the experience in hyperinflations that we have seen elsewhere throughout history.
And in that regard, would certain asset classes, such as perhaps in the agriculture area, make sense, with rising commodity prices translating rising food prices?
Yes, that I'm sure is the case. The other thing, experience from the past, and this is in very sharp relief, is that property prices, but property turns out to be a very good protection against hyperinflation. But before we get there, if you look at particularly residential property, the amount of gearing in that market is really quite staggering. And I don't know about America, but I can tell you that in the United Kingdom, typically the mortgages here are something like 80 to 85% loan to value. They're not all like that, but there are enough of them like that, which basically means that if you get a rise in interest rates from the current level, because the banks and building societies are lending money fixed for 2 or 3 years at about 2.5%, something like that. If that rises to 5%, a lot of people are going to be in severe difficulties. It will put off buyers in the market, and it could also force sellers onto the market as well. So I think that while I would see property as protection in a hyperinflation situation, I think the initial move in property, because of the rising interest rate, rising nominal interest rates, because of that effect, I would have thought that prices are threatened first before they are right to have.
Yeah, and I think also the experience of Chile and in their hyperinflation environment that they went through, there were stories of people trying to sell their properties, residential properties, especially multiple properties they had perhaps for rentals, in an effort to raise cash, to raise liquidity, that actually had a negative effect on the residential property market, even in a hyperinflationary environment.
Absolutely, yeah. I think you're going back to the Allende days. That was certainly true then, and there were stories of people who would literally just swap fancy apartments for a small car just to get the hell out of the country.
Yeah.
But the trouble is, this time round, we're talking about the dollar. And because every other fiat currency is tied to the dollar, I don't think you can just get into a little car and drive out the country and be safe, because where are you going to go?
Yeah, exactly. And so how would this play out in the precious metals? I mean, today we're seeing a significant selling of gold. I think I just looked at it recently before we started here. Why is it going down today, and how do you see it playing out in the medium to long term?
I think very, very short term, I think the reaction whereby the gold price went up was quite natural. In a sense, I think for it to come off the top made sense, because that was also the experience with Brexit. And remember that in the financial markets, I think people are looking at Brexit, if you like, as a trading model for what's going on now. But I think that the moves overall have a little bit, if you like, of government inspiration behind them. It wouldn't surprise me at all if the Exchange Stability Fund was intervening in gold to try and drive down gold to make the dollar look more stable, if you like, over the course of this event. The fact that the equity markets have bounced fairly strongly would tell me that there have been possibly sovereign wealth funds in there, where there would be a certain amount of government direction, again, trying to stabilize things. So these markets, very short term, I think are a bit false. What I would say with precious metals is, again, I look into 2017, I see inflation picking up, and I see bond yields falling, and at the same time, interest rates rising, but never rising enough to deal with the inflation problem. And the reason for that is because of this huge, great overhang of debt. The Fed, in raising interest rates, will be very aware of creating a systemic crisis if they raise rates too much. That they don't want to do. That, after all, is what happened when it triggered the Lehman crisis. We have the potential for a crisis, literally, in my opinion, with a rise in the Fed funds rate to as little as 2.5%. So if inflation starts going 4, 5, 6%, you can see that the Fed actually can't respond to it. And gold will begin to anticipate that. Silver moves about twice as much as gold. So on that basis, I think for a speculative play, silver might be quite rewarding. But the basic story there, I think, is gold is sound money. And what we're seeing with inflation is the dollar is less sound money. And that translates to me to higher gold prices measured in dollars.
And you mentioned that you would see the yields on bonds going lower next year?
No, the yields going up.
Going higher. Okay.
Yeah. Prices going down, yields going up.
Yeah, exactly. For in line with the rising inflation.
Exactly.
Yes.
And not only the rising inflation, but if you think about it, you've got an awful lot of people who are long in that market at the wrong price. So I think there'll be quite a lot of distressed selling too.
So given that, would that mean we're entering into another phase of, like a phase 2, if you will, of the financial crisis, given the inability for Keynesian stimulus through infrastructure spending, or difficulty to do that given the environment, as well as rising inflation, rising interest rates, rising yields? How do you all see that playing out?
Yeah, sort of Lehman Part 2, that is my fear, if you like. But second time round, it's likely to play out slightly differently. And I think this time round, we will probably have a banking crisis of some sort. And this time, I wouldn't be surprised if it was Italy, which actually is a major issue. And I think as that crisis gradually spreads, I think that the response from the central banks, who have learned that they can print money and do QE to, if you like, with impunity as far as price inflation is concerned, I think they will play that trick again. And this time, I think it will prove to be a big mistake. It will be inflationary. And remember, going back to raw material prices, while Donald Trump, President Trump, is trying to push through the idea of more infrastructure spending, China is already in the market for raw materials. It is developing the whole of Asia. That is its 13th year plan, which will be followed by the 14th and 15th. She is going to put in huge, great infrastructure. It's going to be an industrial revolution for the whole of Asia. That is her plan, and she's taking her own population into the middle class. There will be more middle-class Chinese by the end of 2018 than there is in the whole of the population of America and Canada. So you can see that this sort of rush for infrastructure spending is actually happening in various countries at the same time. And it's partly driven by the central banks as well, because they have run out of bullets, and they're effectively turning around to their governments and saying, over to you. We've done what we can. We can't do anything else. It's time you spent some money. Stop being, no more austerity, because it's not getting us anywhere. Their analysis, incidentally, is completely wrong, but it's not going to stop them doing it.
And so that would mean rising commodity prices across the board?
Yep, absolutely.
Wow, that's some interesting times ahead of us. So, Alasdair, how can our listeners learn more about your work at Gold Money?
Well, I write a weekly article for the Insight column on goldmoney.com, and you'll find it under the wealth tab. We've got 3 tabs there. There's personal, business, and wealth. Under wealth, we have all our research efforts. So you'll find me there. And also on my own blog, which is financeandeconomics.org. O-R-G.
Great. Thank you very much, Alasdair.
That was my pleasure. Thanks.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.